All right, students, good afternoon. Welcome back to another episode of Everything Business. And as was promised, I had said that I would be doing a more advanced trading income statement and balance sheet. Well, yesterday I would have uploaded a video about the adjustment to income statement. Well, now we're going to look at how we create a balance sheet with adjustments. All right, so let's get right into it. So just to recap, right, the adjusted income statement, this was it. We were looking at busy traders. This was the adjusted income statement. Key points to remember is when you reach the gross profit, you would have had revenue, but in this question, we don't have any revenue, right? But pretty much leading up to the gross profit, the trading account, they call it, right, in the income statement, there's not much to adjust. But when you reach the gross profit, you would add revenue. This question did not have any revenue. We are here now at the expenses, the section, the profit and loss section, and you would have to adjust your expenses based on the information that is given in the footnote. If you look on this side, you will see rent paid in advance, insurance accrued, wages accrued. Two terms were brought to the fore in my last video when we were talking about adjusting the income statement, and that is accrual and prepayment. Accrual is really when you owe money and should be added in the income statement. Prepayment is when you are paying in advance and should be subtracted. And so if you have not seen my video before this one about adjusting the income statement, then you need to go and see that, all right? It will be in the description and at the end of this video. So let me know what you think about the video so far, all right, in the comment section as well. Remember to like, subscribe, and share. I really want to emphasize the subscription because 81%, based on the statistics, 81% of my viewers are not subscribers, all right? So I want you guys to subscribe. All right, so let's move into the balance sheet. Now, as was said, the balance sheet, it has 4 headings, right? Balance sheet has 4 headings. In general, a simple balance sheet, a more complex balance sheet would have more than 4 headings. It would have 5 headings. For this question, however, we will not have 5 headings, right? And I'm going to do another question that is more advanced that you will be able to see how the 5 heading would come in. All right. So the first heading that we would have is fixed assets. So you would list our fixed assets. You know that you start with your heading. See there? Start with your heading, busy traders balance sheet as at, right? And if you realize, my columns are labeled cost, depreciation, and NBV stands for net book value. And you may say, sir, what is this for? Don't worry about these labels. These labels they are only there, right, for the fixed assets. So you will see the labels on these columns. They are not there for any other reason but for the fixed asset section. So after you finish the fixed asset section, it's back to normal, right? Like any other balance sheet. So we look in our trial balance and we realize that we have one fixed asset here, machinery and equipment. We look and we see we have premises, right? Is another fixed asset that we have. So we have to write them down. And we write them down in the order of permanence. Very good. So premises would go first because it's the most permanent. So premises at cost is 15,000. 15,000. See it here? 15,000. Right? We have to look if we see any depreciation for premises, right? And you may say, sir, where would we find that? So the depreciation would be in the footnote. The depreciation for this year would be in the footnote. We didn't use any depreciation in the trading and in the profit and loss, right? So, you know, we would not have any, right, for premises. The depreciation figure for premises could also be shown in the trial balance. As a matter of fact, the depreciation information that you put here is generally or is normally the footnote depreciation or the depreciation that is shown in the footnote plus the depreciation that is shown in the trial balance. And you may ask, sir, what is the difference between both of them? Well, the depreciation that is shown in the trial balance, right, is what we would call the accumulated depreciation. So you may see they have it as provision for depreciation, right? It's the same as accumulated depreciation. It is the depreciation that was there before this year. And then the depreciation that is shown in the footnote is the depreciation for this period. What you would have to do is to add the depreciation for this period to the depreciation for the previous period to put right here, right? So for fixed premises, there is none. So let's put a little dash there. There's nothing. So the net book value remains the same for the premises. So let's look at machinery now. Machinery and equipment. And you will see what I'm talking about. So machinery and equipment, the accumulated depreciation is what? 4,500. See it here? You have to add it. So 4,500. 4,500 plus the depreciation that is shown in the footnote, 1,500. 1,500. And that would give us $6,000. So the cost for machinery and equipment is 15,000 as well. The depreciation, machinery and equipment provision for depreciation, it would be this $6,000. And so what we would do now, we would subtract the depreciation from the cost, right, to get the net book value, which would be 15,000 minus 6,000, which would be equal to 9,000. So the net book value is 9,000. All right. You can pause the video and go back and look at what I did right there. All right. There are no more fixed assets, so I'm going to close off. So this, the cost column would be 30,000. The depreciation column would be 6,000. And the net book value column would be 15 plus 9, which would be 24,000. All right. We are not going to use these two figures anymore. And so we are now going to underline these two figures to signify that we are finished with them. But we're not going to underline this 24,000 because we are going to be working with this figure moving forward. All right, so that moves us now to our next heading, current assets. All right, and so in our current assets section, we normally start with our closing stock, right? Our closing stock figure, and it is located outside the trial balance, 9,000. So closing stock is 9,000. All right, and we are now going to add, sorry. Well, we're gonna have debtors, right? However, the debtors figure is to be adjusted. When you're doing adjustment, you have to be careful when you're recording the debtors figure, because if you have provision for bad debt, then that is what we will have to use to adjust the debtors figure. In the trial balance, you may find a provision for bad debt figure, right? And if there's a provision for bad debt figure in the trial balance, you would not use that in the profit and loss. What you would have to use in the profit and loss is the one that is shown in the footnote, right? And then when we get to the balance sheet, because the balance sheet is a totals account or a total statement, you would have to add, similarly to the depreciation, you'd have to add the provision for bad debt that is in the footnote to the provision for bad debt that is in the trial balance. All right, so please pay keen attention to that bit of information. But we don't have any provision for bad debt in the trial balance, and so we will just have to work with the provision for bad debt that is given in the footnote, which would have been the provision for bad debt for this period. So the debtors figure is to be adjusted. We're going to put it in the first column. So debtors is 11,250, 11,250, and we're going to less or subtract provision for bad debt, which is $300. So we subtract it, and that should give us 10,950. But let's use a calculator. I always tell my students, do not depend on your own understanding according to the Bible, right? So 11,250 minus 300. If you have the calculator, you use the calculator. 10,950. Right. All right. So now we have adjusted our debtors figure. When we are doing adjustments to final accounts, when we are talking about adjusting the balance sheet, there are two items that are included in the current assets section. One of the item is prepaid expense and accrued revenue, right? Prepaid expense in this case would be rent paid in advance. So in this case, it would be rent. There is no other prepaid expense. If you had other prepaid expense, you could have opened a bracket and put all of them there. So the rent is $2,000. We do not have any accrued revenue. An example of an accrued revenue could have been rent received owing, right? So you would have rented your place to somebody, they owe you rent. So that is rent received owing. That would be an example of an accrued revenue, right? So the word accrued means owing. So they owe you revenue. So we don't have that. So let's remove that. All right. So we don't have any other prepaid expense nor accrued revenue. Now we can go with our bank. Balance at bank. What is our bank statement? Bank balance 4,000, sorry, 125. And our cash balance is 3,000. And so now we can close off our current assets section, add up all of them, get the calculators out, right? So it is 9,000 plus 10,950 plus 2,000 plus 4,000, I'm sorry, 4,125 plus 3,000. That gives us a total of 29,075. 29,075. So that is our total current assets. We now move to the next heading in the balance sheet, less current liabilities. You can look and see if you have more than one liability. If you have more than one liability, then it will be liabilities, right, for the English persons. And if you don't have more than one, then it will be current liability. In this case, it is liabilities because we have more than one. All right. So let's look at it now. So you have your creditors, right? Or you can also call it accounts payable. Accounts payables. So your creditors figure is what? 8,250. 8,250. And a new item to go into the current liability is accrued expense, right? Now we have two accrued expense. We have rent paid in advance. Sorry, not rent paid. Wages and salaries. So wages and salaries, that's what? 1,700 plus insurance. And the insurance amount is what? 300. Right. So that would be, give us a total of what? 2,000. Very good. Right. We don't have any other accrued expense. You would also put prepaid revenue here. So let's say using the same rent received owing, rent received, that's a revenue. But what if your tenant pay you, right, in advance? That would be prepaid revenue. And the reason why it is a liability, right, is because now you will owe that tenant that money that they paid in advance. But we don't have that in this question. All right, so let's remove this, but it would go right there just the same. So let's add up, right? And we get now 10,250. 10,250, that is our total current liabilities, right? And now we're going to subtract our current liabilities from our current assets to get our, if you said working capital, that is correct. So minus 10,250 equal 18,825. 18,825. And this now is our working capital. Right. Good. Now, we are now going to add this figure to our fixed assets to get the total net fixed assets, right? So 18,825 plus 24,000 would be equal to 42,825. 42,825. That is our first double line figure. What I was saying to you, right, is that there's a fifth heading that you would have in the balance sheet when you're making adjustments. That heading would be less long-term liabilities or liability, right? It depends. It's normally one. You don't normally have a lot, right? So say, for example, you had mortgage. That's an example of a long-term liability. You would put the information there, right, and do the subtraction. Then you would get the first double line figure, right? Or you could say long-term loan. Put the figure there, right? Then you have the first double line figure right there. But we don't have any of that. We don't have any long-term liability, right? So it's not going to be there, right? Do you want me to leave it for you? No, let me not leave it there. Next thing I confuse persons. So yeah, it would be there though, right? We don't have any long-term liability, so I'm gonna delete that. And I'm going to delete that. So now what you would do, you would double line this figure. Because that is our first double line figure. All right. Now we move to the next heading, finance by, right? So capital, what is our capital figure? According to our trial balance. You see it there, 37,500. 37,500. We add our net profit. Add our net profit. The net profit that we got from the previous one, 12,825. So 12,825. So 37,500 plus 12,825 would be equal to 50,325. 50,325. Then we move to the next item, less drawings. This is where it goes. And our drawings figure, if you look in the trial balance, it is 7,500. So less 7,500. And that would give us now what we are supposed to get is the next double line figure, the one that was there before, minus 7,500. And as you can see, our balance sheet is correct. 42,825. And we got both double line figures to be equal. And that is all we know that our balance sheet is correct. All right. So let me know what you guys think about what I just did in the comment section. Let me know if you understand. If you don't understand, whatever it is that you don't understand, please let me know in the comment section. All right. Feel free to reach out to me. My number is, if you need private tutorial classes, feel free to reach out to me. My number would be in the description. If you have waited for this long, if you made it to the end of this video, that is your reward. All right. Take care and walk good.